We are very excited to have with us today two globally recognized experts on emerging trends and technology in the payments ecosystem. We have with us Aleks Teichman, who is head of acquiring at Cross River and one of American Banker's most influential women in payments. Now, I come from the banking space, so I always shout out the bankers and the compliance people. So good morning, everybody who's coming from that space. We also have Todd Ablowitz, who is the co-founder and CEO of Infinicept, which enables companies to get payments going their way. And I'm sure we'll talk a little bit about more about that as our conversation goes on. This session is going to help us answer the question of who will win the payments race, digital or traditional. So take it away.
Awesome. Thank you so much. This is a real treat. I've really been looking forward to this because I think, Todd, you and I were always on stage and we're always kind of either moderating or speaking or doing some sort of, blabbing on stage. And then separately we chit chat on the side. And I think this gives us a little bit of a forum to kind of have this conversation, this dialogue, and interview each other, so to speak, and really pick each other's brains. So I'm really excited about this. The future of payments is now. I think is a great way to start, right? And to kind of set the stage. There's so much that's happening in payments across the various different payment flows, across different industries. Verticalization of payments is super hot right now. So I guess first question's for you, Todd. What's exciting about payments for you now? What do you think is super cool and super innovative?
Well, obviously, I'll start with the thing that I have spent the last decade on and that Infinicept is focused on, which is embedded payments and embedded finance. It's remarkable how technologies converged between the high-speed broadband, object-oriented code, SaaS technology, and the huge advancements. So we're just seeing the beginning of AI, right? Everyone wants to talk about that. I think I said, do I have to put a quarter in the cup? Because I said it. We agreed that that's too much of a buzzword. But what we're seeing is with all these advances in technology the last 20 years, the last 10 years, every kind of business has a software company. I mean, it used to be dog walking software. Now it's poodle walking software is the metaphor, right? So as you see that happening, how does that relate to embedded payments? Well, everyone has to accept payments for all of these different things. So the first thing that all of these vertical software companies did was add payments. And this goes all the way back to Shopify and even before that. And so the first thing they do is add payments. Well, where does embedded finance come in? Once they add payments, and that's kind of vanilla now, right? They're gonna add the payments. It's gonna be bundled in. It's like 70% of Shopify's revenue is from payments some quarters, certainly always over half. And what do they add next? They add capital. These businesses want access to money. Banks don't always have an easy time making that money accessible, and fintechs often have a good shot at it. So you add embedded finance. And then the next thing you know, maybe it's receivable financing. Maybe it's tax calculation or payroll, and it's endless, right? The number of things in embedded finance. So it's like a $825 billion market by 2030. So that's one. Second one that I am paying a lot of attention to right now is network tokens. So this is a technology that the card networks invented. Actually, it really started around Apple Pay. When Apple Pay came out, it was a way to put a card onto a phone without having it be the same card number. And so they created this tokenization infrastructure, and the number of things they're doing to differentiate between did I say I want my card used virtually, right, online? I even make the card, the tap gesture. Did I say it, or was it a recurring? Or did the merchant just initiate it without explicit cardholder approval on that one? How does all that come together? And they have interchange implications, and the network tokens get updated. Like when you lose your card, they get updated behind the scenes, so the merchant doesn't even have to know. They get informed sort of informationally. There's two more, and then I've got a great question for you. So the third one is all things B2B, business to business. I heard a stat, I haven't validated this one. I heard a stat that B2B payments are $120 trillion. worldwide. I know that they're 30 trillion in the US. That is a staggering number. That if that doesn't tell you that our kids' kids will be able to be in payments and it'll still be a good business, I don't know what else does. And then
I
the
wrote that
last
number down. I wrote that number down.
Yeah, it's worth it. I
Crazy.
mean, as I said, I heard that number. Haven't validated. I have validated 30 trillion in the US before. And then the last one, I don't know the numbers on it, but all things healthcare. Everything with healthcare, what a mess, right? Getting healthcare paid for. There's insurance. I remember 15 years ago, maybe 20 years ago, working at First Data, we had a whole team trying to solve that. And they were so far from being able to even, crack the surface. 15, 20 years later, we're still a lot of ways to go. So those are the things that I really, that I've been paying attention to.
Wow.
So yeah, it's really interesting, and there's only so much one company can do. So we're really focused on the embedded payments and embedded finance, but we'll see if we can dabble in a couple of those other things where it makes sense.
I think, you can't boil the ocean, right? You've got to tackle one problem for one particular, use case and kind of go deep. So
absolutely, and you guys do a great job of that. I know we even talked about that when we were sitting in New York. We talked about how we have to focus. It's so important. So you have a saying, I've heard you say this a bunch of times, and I'm really interested to hear more about it. You say payments are not only purchases. So tell me more. What does that mean to you? And if not, okay, what is it?
So I always say I'm a card girl. I was born and kind of bred in the card industry. I originally started working for JCB, which is a card network, and kind of went down and down and down and down a rabbit hole. Yes, years and years ago, before they were on MAP, that did the whole MAP conversion and all of that, when we were still going direct to merchants. But when you think about it, or when I thought about it before I even joined Cross River, I always thought about payments as being purchases. It's card transactions. It's, retail, moto, e-commerce, right? And proliferation of e-commerce, and especially through COVID. But then when you think about it, it's really so much more, right? When banks look at payments, they look at money transmission. They say, okay, I've got to move money, ACH, so on. It's wires is a big thing, right? And I think now, and over the last few years, there's really been this kind of convergence of the two, of how you really continue the value chain for those purchase customers, so merchants, businesses, and how do you help them solve problems that happen to be not only purchases. It's not just a card transaction for the purposes of purchases of goods and services. And how do you kind of go down that those various use cases as you go deep into, and kind of verticalization deep into your vertical or specialty or software that you're offering. So just some examples. You mentioned healthcare, right? I was doing a little bit of research, and apparently healthcare is a $1.37 trillion industry, right? In 22 alone, over $1 trillion in healthcare payments went out just for the purposes of payouts, not for paying co-payments and deductibles and a kind of like what you consider purchases, but outside of that box, continuing that value chain and saying, okay, how else can I support that consumer within the healthcare industry, outside of just enabling them with a piece of software or even a hardware to accept a payment, a purchase payment? How do you help them now really solve big problems where you're moving away from paper, you're moving away from checks? Now, potentially patients who need to get reimbursement are getting those funds faster. Doctors who are getting their claims paid are getting those funds faster. And how are you ensuring that you're really solving bigger problems outside of just, here's a piece of software, here's a piece of hardware? Not to minimize that. That in itself, I think, has moved and made tremendous strides, particularly within all the SaaS that's available, all the software that is now available specifically within the healthcare industry. But how do you now take it to the next level and take it to the next step and say, okay, now that I'm kind of going down, and I always go down vertically within healthcare, let's say, how do I now take it and really go horizontally and offer them different types of solutions within payments, and then tap into potentially financial services, as you mentioned? And that was a great kind of connection there, where okay, potentially, are they looking for funds? Are you able to also embed some sort of, whether it's a credit line or whether it's some sort of capital that is now available to that healthcare provider? So when I think about kind of payments or not-on purchases, I always think about what else can we do? How else can we support our business? And you mentioned B2B earlier. Another example is earned wage access, right? And when you think about restaurants specifically,
Yep.
Or really any service industry, and the employees that work there and the speed of pay at which they can get their funds and their earned wages. If you think about it, we are so set on and so kind of almost conditioned to know and to assume that you're going to get paid 14 days after you start actually making that money. 60% of the US still lives paycheck to paycheck, unfortunately. And so being able to get access to those earned wages faster is such a powerful proposition, right? For a lot of workers that are living paycheck to paycheck. There's so many other use cases, but again, it's like we always talk about flows of funds and how do you help, how do you really solve problems for very specific groups of people. I think, kind of don't boil the ocean, solve one small problem and figure out how to do it in a kind of in a compliant way and regulatory kind of safe way.
Can you do me a favor? Double click. I love the earned wage access story. I use the restaurant story. Can you double click so that everyone can kind of digest, right? I'm a server. I work my shift, would work at double, get off at 10 p.m. And what is the thing that's happening to get me my money a little bit faster? What is it that the provider's doing to get me money?
So traditionally, they work with a payroll provider, right? And the payroll provider says, okay, how much do you want to pay that worker? Okay, they've worked 20 hours or they've worked 100 hours, right, over the last couple of weeks or over a week's period of time. And traditionally, they would just kind of get money deposited into their bank account, 14 days potentially, right, at the most, after they've worked. So in this particular scenario, there's fintechs and kind of payment companies that allow for those wages to get paid out sooner. So there's different types of, obviously different rails that they can leverage in doing so. We always think about kind of payment rails and how do you use and offer ubiquity across, ACH, right? Real-time payments via the clearinghouse. Now there's FedNow. We look at it as just instant payments, regardless of kind of who's clearing it and who's doing all the back work. Push to debit, which is kind of Visa, MasterCard products where you can push to a debit card at disbursement. So using one of those rails in order to pay that worker same day or next day, depending on what that restaurant or what that merchant, how they want to pay them, how soon they want to pay them. There's another, and I want to make sure we're not confusing the two, but there's another kind of use case or early wage access where it's kind of like you're paying ahead of time. That's a little bit different. I'm not going to talk too much about that, but this is really, kind of earned funds, earned wages that you've worked for and that you earned and that you could potentially use, right, to pay for groceries, gas. I mean, one of the big things that came out throughout COVID was people weren't able to even pay for gas, and there were really big problems for a lot of workers in our country. So solving those types of problems and being able to literally pay them faster. As you know, real-time payments in FedNow or instant payments, kind of Visa Direct, MasterCard Send, which are the push to debit products, they're almost instant. Like I roll my eyes because they really are instant. It's 30 seconds, I think, or something along those lines. So I always put them in kind of the same bucket. They're all instant payments or near instant payments. And yeah, those can be leveraged. I can literally push the button and have that payment go out right now. They are all based on good funds. So the restaurant has to say, okay, here's $500 that I want to pay to my worker in order for those funds to go out.
It's their money.
It's their money. Exactly. It's their money. And somebody's holding on to it, right? And making a few percentage points when really the consumer or the customer should have access to those funds sooner.
One thing I love about this as we move on is there are plenty of ways that you can work in the payments. You look at the payments industry and it's like, oh, we're capitalists and that's great. We love that. But we can do social good with our products. And there's lots and lots of ways. Earned wage access is a great example of a positive social impact from doing what we do, which I love.
I think fintech across the board, right, there is this mandate to enable financial inclusion. And really where it was, and like, I love the history of it. When you think about why fintechs came about, is because they wanted to offer different products and services out into the ecosystem for consumers, for businesses, that traditional banks weren't able to really offer. It wasn't available because banks had their box. This is my underwriting box. If you don't fit into this box, then we can't help you. I'm sorry, right? And so 20% of the country is still either underbanked or unbanked. So when you think about the problems that fintechs are solving, as much as you're right, we're all here to like to make to be financially successful, but really the purpose was, how do I tap into a specific vertical of consumers and help them solve a problem? So I think that's been across the board, is how do you do it, for specific problems and help them really kind of continue. Todd, the one thing, I hear this sometimes and I kind of roll my eyes, but there's this notion that payments is super commoditized, and that it really hasn't changed much, and it's still a race to the bottom, and so on and so forth. I'd love to hear your thoughts on it. I have my own very strong opinions, but I'd love to hear yours.
I love that saying, the race to the bottom. 27 years in payments, and I've been hearing this for 27 years. And the only thing that's happened is margins have gone up, not down. And so I have a feeling I'm with you on this one. I just roll my eyes, and I find it just so lazy. It's so lazy. What you see happening is companies that are lazy or bloated or bureaucratic or just can't get out of their own way. They don't do anything. They don't innovate. They don't enter new segments. And so you see a bland product that's no different than it was 25 years ago. And of course it's going to get commoditized. If you have a crap product, people won't pay as much for it. So what do? Well, there's a couple of things people do. I think this whole day is part of it. One of the things they do is people or companies just drop their margins to nothing. A second thing they do when they have no innovation is they find a segment that's dirty or they call it high risk. Some high risk is fine and some high risk is really gross. And they go and they enter these areas because there's all kinds of margin for people who want to do bad things. And if you want to really, I was on a panel once with a private equity guy Ned May, and he said he said it much more elegantly than I could say it. But what you want to find is this intersection between a lot of value created. People always say value-added services, blah, blah. But where is that thing that really changes the business for the merchant or the acceptor, right? Because if payments are not just purchases, then it's not just a merchant, right? So you're finding, where's this real tangible change to their business? And then where's our fair share of that? With that fair share being as large as possible, with that trade being reasonable. And he said it much more eloquently, but that's what I think companies should be on the search for. And when you look at, for us, we see beauty in software companies getting more ownership of their payments, of all kinds of payments, starting with purchases, right? For some of them. But we have customers that are in insurance. We have customers that are in government. We have all these different verticals. So network tokens. Well, there's a savings there. There's a value created. Why? Because the merchant doesn't have to sit there and update a card number. Or you get those god-awful emails like, hey, can you call the 800 number to update your cable credit card because you lost it at the bar last night? Okay, that's me. But so I see those emails, or I get a decline, or get a letter like your past. You're like, what are you doing? There's an account updater. Well, network tokens allow that to just seamlessly update. Think about how much money gets saved from doing that. So you go and do that in an elegant way, you're going to get value but you have to learn it. You have to teach your go-to-market organization. How do you build this value? How do you explain how this matters every single day to the, in our case, the software companies' merchant customers. So no, it's not a race to the bottom. That is just stupid. And these companies that rely on that are lazy.
You know, somebody once said something to me, and it has stuck through with me for years and years. And you probably know who said it if I tell you, but they said evolve or die. And I don't know, every time I say it, it still kind of gives me goosebumps a little bit, but I do believe that's a fact, right? I think across the board, especially in our industry, when you think about consumer value proposition and payments for consumers and real-time payments and all the, Venmo and Zelle, and we as consumers are so much further along when it comes to payment innovation than what we've been able to, as an industry, extend out to businesses and to merchants. And merchants don't have the luxury of getting their funds instantly. They still have to wait T+2, T+3, longer and longer and longer potentially. And so how do you help them do that a little bit better, a little bit faster? And to your point, it's by not being lazy. They may see it as very seamless and easy and kind of frictionless, but our job and our work is to be able to help them do it a little bit potentially either faster, definitely safer, and better in one way or another. And so the only way you can do that is by not being lazy, to your point. So I love that you said that. They're just lazy.
Well, and that leads right in. You teed up my next question perfectly, and you touched on this briefly, the rails, right? And the new hot thing is faster payments, at least in the press. How much it's affecting transaction volume, you would know better than I would know. I would love to hear some of the immediate impacts that you see happening. Like you mentioned earned wage access, not early wage.
The earned, yeah.
But you said earned wage access, but bring to life a couple of things that the instantness and good funds nature of these new payment rails. Let's talk about it.
So the first thing I'll say is not what it's doing, but what it's not doing. And what it's not doing is replacing cards for purchases. Because right. I've heard that question.
We're on the same topics.
Oh my goodness. Does that mean that Visa and MasterCard are going to go bankrupt? And we're all going to be kind of in using RTP and Fed now for buying our coffee and buying AirPods online and whatnot. So the answer is no, right? So even the core functionality within real-time payments via the clearinghouse or FedNow, which are both instant payments that leverage slightly different networks, for them specifically, it's really only for push. You can't leverage those rails just yet. It's innovation that's kind of, I think, coming around, and it's being built. The network is still continuing to be built. But really the purpose of those rails are for payouts and not for pay-ins. So some use cases, right, that you mentioned earlier. So healthcare is a good one. Insurance is a good one. Anywhere where you need to send a payment out to a consumer or to a business. Another really good example, specifically within merchant acquiring, right, and kind of related to purchases, is merchant settlement. And how do I leverage that rail? How do I take that rail and kind of build around it to enable merchants to get funding faster? And there's kind of various payment providers that are kind of working on those types of problems as we speak right now. Those are probably the main ones that I think of. I mean, there's others within gaming. That's another really good example. A lot of business that we do, at Cross Rivers around kind of big gaming payouts and ensuring that the customers can get their funds faster that they've earned through different types of legal gaming rather. But there's, I think for us, ultimately, what we try to instill, because we have API functionality that is across all those different rails that are available that I mentioned, is to have total ubiquity and really put the consumer at the front of it and allow them to make the choice. So if I wanted to go to my bank account instantly, then I can choose that. Or if I'd like for it to be a little bit later, and I'm willing to, and I don't want to pay for that faster funding, then maybe I'll use an ACH. Or if I wanted to go to a card. So really putting it in my hands as the consumer, I think, is ultimately the goal across the board. So ubiquity, ensuring that when you're talking to merchants, when you're talking to businesses, it's something that they can kind of lean into, and they get to make that choice.
We're already using faster payments to fund merchants through our software and our PayFac, and it literally was a topic yesterday. In our case, starting with same day ACH, which is a nice easy bridge to get T+1. So you see those impacts. It's really cool.
I was going to say, you probably already see the impact, right? And on helping merchants get their funds faster. So kind of crawl, walk, run, and kind of tipping your toe in the water and kind of getting access to those different rails, I think is super important. And we're going to continue to build. I think that's ultimately the goal. So potentially we will be able to leverage those rails for pay-ins of some sort. So that's really exciting as we kind of continue to evolve and transform. I don't know if we have some questions, or let's see.
Yes, it looks like we actually did have a question come in, and I'm happy to field that for the both of you. When discussing tangible changes to their business, do you feel that there are value-added services that are designed less for profitability and more to foster customer loyalty? And this might be because there's profitability of another service adjacent to it.
I think that might be, I think I was the one who mentioned value add, so I'll go ahead and answer that. Sure, there's tons of literature out there showing that when customers buy more product, they're going to stick with you. And there's going to be a range of profitability on different embedded finance products. Things like, if my memory serves, things like payroll, not super lucrative. If you're making 100 basis points on payment acceptance volume, you're not going to move the needle in a big way with payroll, but you sure will make sure that it's harder to leave if you have to replace your payment acceptance and your software and your payroll provider. That's like going upside down.
And I can even add to that, right? So Todd, when you think about payroll, even you can double click into it and you can say, okay, well, today you're getting your payroll via an ACH, next day ACH. If it's the same day ACH, there might be a cost to it. If you want it instantly, there might be an additional cost to it. So those could potentially be, and they are, significant revenue drivers for organizations that really focus around, if a large number of your transactions are payroll and you can charge a little bit more and your customer is willing to pay a little bit more for that instant payment. Those are scenarios that we're seeing every single day. So again, as you go kind of vertically across different use cases and different payroll as being one of them, and go deeper into that specific flow of funds, the question becomes, okay, how do I add additional value to my customer and potentially, kind of benefit from it?
One of the things that I think is interesting, and as usual, we're off the script, which I think is a great thing and enjoy it every time. I think I don't know if I can quite tangibly understand this yet, but the faster nature of payments, as that gets closer to ubiquity, I think a bunch of systems that were really important, dealing with batches and dealing with the translation of that, and I think that this end-to-end connection from a purchase even to the merchant settlement and reconciliation, I think you're going to see that. I mean, we certainly are striving for T+0, and customers want T+0. But as that gets closer and closer to happening, how close are we going to get to getting settlement per transaction, right? And that's going to change the entire value stream. When that starts happening, I think it'll take a long time, of course, right? Because these systems have been in place for a long time. But what do you think about that? Do you see evidence of that yet?
So, two things. Yes, I think particularly in other markets that are not as mature, and so they've been able to build yesterday as opposed to 40 years ago, 50 years ago. They're building in a much more instant way where they are able to actually settle per transaction. But not to be the Debbie Downer, but we all have to also understand that we need to do it in a regulatory kind of secure way and have the right guardrails in place to make sure that those transactions are, not fraudulent, right? They're not, kind of enabling money laundering around the world, and so on and so forth. So there's a good balance, I think, between the two, and ensuring that, yes, you can go fast, but make sure, you're doing it in a really safe and secure way.
I'm not gonna be able to say it better than that. I think you nailed it.
Absolutely. And actually, Alex, that's a perfect segue into our next session. So thank you so much for providing that. It really is amazing the more good money flows through the system, and there is a staggering amount, as you both have said, that the more opportunities and the more variety of opportunities there are for bad actors to infiltrate. So next, we're going to be talking about what regulators are doing about that and how they're responding. So I want to thank you both for coming today and sharing your knowledge. So excited to have you. Thank you so much. And we will see everyone in the next session.
This was a treat. Thank you so much for having us.
Thanks so much.
Bye.